From the morning reading, short-term trend resumes as stocks and indices bounce and break out to the upside. All 9 sectors moved higher on Friday. XLF, XLE, and XLV were the strongest sectors, while XLU was the weakest sector. Futures rose 47 cents to close at 38.49. For the week, all 9 sectors moved higher, led by XLE, XLU, XLB, and XLV, all of which led the SPY. Breadth strengthened as advancers led decliners 1.34 to 1 on the New York Stock Exchange and 1.84 to 1 on the NASDAQ. The huge thrust and momentum has started to ease. The McMillan oscillator, which measures the momentum of the market's underlying breadth, moved from really extreme to just really extreme in the past week. When that has happened in the past, stocks tended to do well, particularly if the economy was not in recession and or the S&P 500 was emerging from a 52-week low, both of which apply now. The S&P 500 has regained its 200-day average. Some consider this to be a sign of a change in trend, and the index has done quite a bit better when it's above its medium and long-term averages. Friday's move also came with a large thrust. The psychology of the market has changed. People can only stay scared for a limited amount of time. The belief by this author is that we've worn out the fear surrounding oil and China. It will take something new to really scare investors again. Perhaps if the Fed starts to raise interest rates again, that will precipitate a major decline. Unless these indices close back below the 30-week averages, this author will slowly reinvest in stocks. The composition of stocks hitting new highs last week is amazing. Of the 152 stocks over $15 that hit a new high last week, 53% had dividend yields of 2% or more and 26% paid 3% or more. The most frequent industries in this new high list were utilities, 24%, followed by REITs, 7%. In other words, 31% of the stocks that hit new highs last week were utilities and REITs. This is not a growth stock market. The winners of the bull market, especially biotechs, have been decimated. The boomers, smarting from their losses and earning nothing in their savings account, are piling into safe dividend-paying stocks and ETFs. Perhaps in a few months, after people become more confident of a market bottom, people will take chances with more speculative stocks. For now, it looks like solid dividend-paying companies are where the new highs will be seen. Of course, we'll get the sell in May season, and if the Fed starts to raise rates, there may be no place to hide from a reinvigorated bear. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for the investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:54 a.m. Central Time, and I'm recording this in preparation for the market day of March the 14th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And conditions in the overnight were, not terribly scary or invigorating. S&P futures at the time of this cut were down about 4 points, or just a little below scratch. Russell futures were down about 0.2. NASDAQ futures, like the S&P, down just below scratch, and the Dow's right at scratch. Crude oil's down, though, large, 2.34%. Euro's down about 0.4%. Bonds down just below scratch, and gold also down just marginally, about 0.2%. In overseas action, they're going the opposite direction. China's up 1.75%, Hong Kong up over 1%, Japan up about 1.75%, Germany up about 1.5%, United Kingdom up over 0.5%. And macroeconomic reports for today in the United States, there is nothing of note. And on Tuesday, looking forward, we have core retail sales, PPI, retail sales, core PPI, Empire State Manufacturing are all on the slate. Now, looking past that, we do have some FOMC activity in the middle of the week. So just be aware that we could have more activity as we develop the week. In terms of market condition, our current volatility conditions are relatively benign. The short-term VIX is down to a 15.2. We're starting to see some VIX levels that are the lowest of the year. So certainly a lot of fear has come out of this market. We're certainly also not to the other extreme. We're a long way from being complacent, but the stuff that's up over 18 and truly the land of the bear has largely resolved. Skew a little bit elevated just above the warning level at 128. IV percentile very, very low at a 19 on the S&P, Russell 22, NASDAQ 22, and Dow 17. We did have standard deviation moves put in on a close-to-close basis on all 4 indices on Friday, with the Russell leading the way with a 2 standard deviation up move, the others at 1 standard deviation move. In terms of current chart activity, let's take a look at a few things there. Here's the SPX, and you see the very important clearing of the recent highs. So this bull flag pattern has fired. Remember, the big question last week was this going to be the top of a wave 2, and then we were then going to fall into something much more ominous potentially, or was this just the latest bull flag pattern? Well, so far the answer is that it's the latest bull flag pattern, and as a result of that, we've now opened up into the potential to come up into this prior range activity, and included in that prior range activity is coming into the prior highs, the prior 52-week highs, which will be back last Memorial Day week. So it'll be interesting to see if we start to fill this space. We've got a gap right here, which will certainly be attractive to many. And certainly this 2060 area is thought by many of the authors that I was reading over the weekend to be the next likely kind of target zone. So that's about another 40 points away, and that's not that far away. So we're starting to get into some really significant areas in terms of making a run back for the former all-time highs. Who would have thought that 4 weeks ago as we were tickling 1800 on your S&P? So what a difference 4 weeks makes. We've had bull flag, bull flag, bull flag, bull flag, 4 bullish continuation patterns. We've come through major resistance areas, cleared the top of the cloud, had a bull flag that cleared and confirmed above the cloud. So really, your bias has to start to become more and more confident. Though, as one of the morning authors mentioned, the composition of these new highs are being driven by dividend-paying stocks, REITs, and utilities, and other like dividend aristocrat type of companies. So just be aware that while certainly things have become significantly more healthy, that it is not a broad health all the way around in terms of who's truly leading. Now, we also, and we'll get into the sector specific in a few minutes, we do have to acknowledge that there has been increasing activity in recent days in some of the higher beta areas. So they are participating, just not quite to the same degree that you have with the, the utilities and stuff like that. So let's take a look at the Dow. And there we go. Dow, very much like the S&P pattern. NASDAQ. Now, NASDAQ's come into quite a bit more resistance. It has trailed. So again, kind of that evidence what one of the morning authors was talking about, that the higher beta areas aren't quite as bullish as some of the others. Now, obviously the last 4 weeks have seen significant improvement, but look at this. It's been bumping its head against the top of the cloud, and Friday's activity just brought it back up to former highs, not a new confirmed high, not above the cloud. So there's a difference here. So just be aware that tech is not participating yet at the same degree as the others. And then, of course, here's the Russell, which did have that confirmed breakout above the cloud, but then trailed back, and then Friday's activity did not even get to the high, intraday high of Thursday. So this bull flag pattern has yet to really kind of fire. In fact, this bull flag pattern hasn't fired. The trigger would have been 20 cents above, or just above this wick here. We didn't quite get there. So the Russell and the NASDAQ decidedly weaker than the Dow and the S&P, which by their nature are more defensive oriented, more likely to be those dividend paying type stocks. We'll take a look at bonds. Bonds, of course, have been coming off, which is something of a confirmation of bullish equity. And then also the volatility also been coming down. Again, a continuation pattern to the downside, which is in an inverse to the equities. And as such, this confirmation of gaining strength in those markets. In gold, gold, of course, not always correlated with the markets, and right now we've got the breakout pattern from the pennant and then sideways chop. So waiting to see where this goes. All important right now that this area holds, and you see there is something of a support cluster from various different systems that are providing support to gold in this area. We would expect to see that gold would continue up. Any type of failure that you get would be significant to that bullish trend. And let's see here. Let's go back to the daily report. And we've been increasingly seeing stronger and stronger signs of bullishness here. Our market term phase opinion still remains at phase 4, price patterns near horizontal resistance, but that's a good pattern. We like to be there. And that pattern of bullishness can last for multiple weeks in a typical bull trend. In terms of the 3 market timing signals, the first one from IBD is confirmed uptrend, though its accumulation distribution scores still remain relatively weak, with the NASDAQ at a D+ and the S&P at a C-. The GMI index, our second signal, actually improved a notch to a 5 out of 6, with a buy signal in place since March the 2nd. The third market timing signal, also mechanical in nature, is the stock charts decision point scoreboard, and we particularly like this one for the fact that it provides multiple indices as well as multiple time frames, and you see what we've been talking about and looking for with the stack starting to come up on play with the intermediate term. We are now seeing that to a greater degree. We have both green arrows and the intermediate term on the Dow, and we've now had 1 and 1 on the S&P 100 and 500. So things are starting to truly show that this is not just a short-term balance within a bear trend, but is starting to have some more significant legs. So it's not yet all clear. We want to see green across the board here and have a true stack of signals, but you have to give acknowledgement that the consensus here is that we are still that market in transition, but an improving market in transition and moving towards the upper regions of that transition zone. In terms of position sizing opinion, both systems are now at 100%. Intermediate term market posture very strongly bullish with a weak bullish sentiment line. You see all 4 indices up over 80 and the 2 more defensive ones up over 90 still. The strength trend itself is a weak bull trend, but improving. So we certainly recognize that as well. Hedge warning status remains at a 0+, and we'll probably see this 0+ last for an extended amount of time as long as conditions remain relatively bullish and things do not deteriorate. Normal with elevated risk conditions is the definition of a 0+, so that certainly is in alignment with what we're currently seeing. In terms of our special opinions, option income strategies, the VIX is now within the acceptable window to initiate new positions for even novice traders, so pretty much it's all systems go in terms of this opinion for option income strategies. Cover call strategies and put selling, these have also been updated over the weekend in that conditions are now fully acceptable to initiate new positions for novice traders. Some of the defensiveness that we had is starting to ebb off. we're still retaining some defensiveness, and you'll notice that the ratio, instead of 3-to-1, is now 1-to-1, of 1 in the money for 1 out of the money strikes for active positions. Also upgraded the ratio for low beta, high beta. It's also 1-to-1 now, with the suggestion that you go with 1 low beta position for every 1 high beta position. But this is starting to mix in a little bit more aggressive positioning and the construction of the covered calls. So kind of keep that in mind. You want to consider legging into covered calls with conservative setups, though, through well out of the money put selling. If you use put selling, whether to leg into a cover call and accumulate a position, or you're just simply selling positions to accumulate other broader holdings, you might want to consider having a position size that is absolutely in the scale that you are willing to own. In terms of the special volatility based warnings, that you can see it's all black here. There is nothing here of concern. Trend based, also all black. Intermarket risk aversion indicators, all risk on. Everything very good in all of those sections. So very, very few elevated risk conditions are present at this time, and you have to take that into account. In terms of sentiment indicators, we do have in the stock short-term risk an 8. And then this is a 1 through 10 scale, and then the gold at a 7, so a little bit elevated on the sentiment. With sentiment, of course, this is not a reversal signal in itself. It's the when you see these fire off, it is a hit your radar screen, a higher sensitivity to watch for potential reversal patterns. And specifically, if you look at some of these indices or indexes or countries, you know, these would be ones that might be starting to set themselves up for reversal patterns. So just keep that in mind. Sentiment is a separate animal all to itself, and it can remain even illogical and irrational for periods of time as the emotional component of the market. You notice now that the fear and greed index has now come into the upper quadrant. It's now at a 75 and in the extreme greed zone. So that's something also to tell you about the broad market. Remember, this is a compilation of 7 different sentiment indicators rolled up into a composite score. In terms of the sector specific, we made reference to this earlier, look at all these different market segments that are in intermediate term market bullish postures now. This is well beyond just defensive, so we do have to give account to that. Now, one of the morning authors mentioned that a very large portion of the 52-week highs was being made by the by the utilities and REITs and other kind of defensive areas. But you also have coming in behind those very strong 52-week high setting areas, many others that are also in an intermediate term market posture bull. So the market certainly has broadened in recent days. In terms of Friday's action on the intermediate term market posture sector specific, you can see short to intermediate term is a sea of green, and certainly on the long time frame, that's also improving pretty dramatically. Percent change here, financials, energy, healthcare, materials, all 4 very, very high beta areas were at the top of the stack on Friday. So that also is another sign of increasing strength from those components. While utilities certainly was a leader for the week, and you see here for the week 2.13%. It with materials was at the top of the stack for the week. On Friday, it was more risk on, more high beta kind of exposure being added by the market participants most aggressively. In terms of the relative rotation graph, this is another sign, much like what that author from the morning reading was referring to. Utilities is the #1 in this graph, and this what you look for is to be in this upper right hand corner, and there's utilities, there's retail, there's IYR is your REITs, on the upper right quadrant, those tailing here a little bit in recent activity. IYZ, also telecom, guess what? A dividend paying stock group. So this is not coincidence, but you also have to respect the fact that you're starting to see some of these other groups like retail, like telecom, IYT is transportation. You know, some of these other parts of the market are starting to come on. We have to pay attention to that. We try to mirror the institutions in terms of whether we are becoming more aggressive and where we're becoming aggressive, where we seek to have our exposure. Very much that's what the sector analysis is all about, to help us drive our own behavior in alignment with where the institutions are buying, because it's very hard to make big wins without broad participation by the institutions. So that's enough for today. It's at 21 minutes, so I'm just going to kind of scroll through these. If you see something that you like, just hit the pause button and go to the hyperlink and get greater detail. As always, we greatly appreciate you liking us on YouTube. Subscribe to us on the YouTube channel. Other offerings here that are available. Disclaimers, as always, hit the pause button if you need more time to review, and you see the hyperlink at the bottom for the full set of disclosures. We'll see you back here with tomorrow's YouTube video provided by Falcon Global with the market preview. Good trading in the meantime.